Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Thursday, July 30th, 2020. We woke up this morning to see futures lower, even before all the big news that was due out today, some of which is out, some of which is remaining till after the close. So markets were, let's say the S&Ps had given back about 25 points or so, which is more or less the gain that they got yesterday afternoon. I think the markets viewed Chairman Powell's press conference in a more sobering light. It does tend to happen. Remember what I mentioned about the first move often being the wrong one. And I think markets were encouraged by the chairman's insistence that zero interest rate policy is here to stay, that they're not considering raising rates, that they're not even considering raising rates, that kind of thing. And I think that's what the market focused on. And then I think overnight you tend to get a little more analysis from more analytical types rather than traders who looked at this and said, well, this is the kind of thing that doesn't bode well for the economy. And ultimately, as much as stocks are addicted to Fed liquidity and fiscal stimulus, it doesn't seem like you still have to make money somewhere. You still have to earn money. You still have to get cash flows. By the way, speaking of fiscal stimulus, markets did not like the news also that the fiscal stimulus talks seem to be stalled. Let's call it a stalemate, for lack of a better word. So this morning, the futures were down about 25 points, and I'm referring to S&P futures, 25 points or so, call it 0.75%. Then the economic news came out. That was not good. The GDP number was not as bad as expected, 32.9% versus 34.5% expectation. Regardless of how you slice it, that number is lousy. Do keep in mind that is an annualized number. The real decline is actually about 9.5%, but that still stinks. And some of the other numbers that underlie it were not particularly good. Personal consumption did not beat expectations, 34.6 versus 34.5. The core PCE fell 1.1%, as opposed to a negative 0.9 prediction. And the GDP price index, which includes all the more volatile stuff, was down 1.8% versus an expectation of 0.1. That doesn't necessarily bode well for the inflation thesis that's underlying the recent gold rally, to see that sort of deflation in the economy. One thing to bear in mind, again, with the Fed is Fed and the markets don't really like inflation, but they really hate deflation, because in an economy that runs on debt, you want to be able to pay back your loans with a currency that's worth less, not with a currency that's worth more. Deflation makes the future value of the currency worth more. So that's not a good thing. On the flip side, that means we're seeing negative real interest rates. So it's a very circular situation. Markets choose what they want to. The next piece of news, which came out about simultaneously, was initial jobless claims. That number was more or less right in line, but the continuing claims was just shy of 1 million higher than expected. That's also not good news. I think markets were kind of banking on a bit of a turnaround in the employment picture, and I think with many of the states having to roll back their reopening, it pushes back new employment. It keeps people on the unemployment rolls. None of that is particularly good, and that is the kind of thing that requires the intervention of fiscal stimulus. And going back to the fact that appears to be stalemated in the short term, that's where you have this sort of lackluster tone to the market this morning. It was also not helped by the president's musing about pushing back the election. That's not necessarily, it's a constitutional question as to whether he could even do such a thing, but the fact that he's even musing about such a statement did not put the markets in a very friendly mood. Markets crave certainty and stability, and comments like that provide neither. So it was not viewed as helpful to the market. And now, having digested the testimony of what I'm going to again call the four horsemen of the NASDAQ, Apple, Amazon, Alphabet, and Facebook, Microsoft in there too, but well, the four of them testified in front of Congress yesterday. I think Congress landed some body blows, but didn't necessarily score a knockout punch on any fronts. So the market sort of looked past that, but we have to look at those earnings tonight. Those companies represent about $5 trillion of market cap. Let me say that again, about $5 trillion of market cap. They also represent roughly a third of NDX and roughly 15% of SPX. And they are priced, shall we say, to perfection. there's a lot of good news baked into the prices of those stocks. Just to put things in perspective, Apple, which has delivered solid growth and revenue expectations and generally met them for all, throughout much of their recent history, is up about 90% over where it was a year ago. And that's not because there's been a 90% increase in earnings expectations or any of the other measures that would drive a stock up like that. It's valuation. So markets have put a very premium valuation on these companies. As we saw last week, the companies that have premium valuations can get whacked even when the news isn't that bad. Netflix went down, Microsoft went down, Tesla went down. All of them actually put up pretty good looking numbers, but the market found the one thing in there not to like and took the stocks lower. And in the case of Intel, where there was stuff not to like, look out below, the stock got clobbered. I'm not going out and saying that I'm not an analyst. I don't have any insight into whether these companies can or will beat their numbers. What I do have insight into is that when companies are priced for perfection, they have to deliver perfect numbers. And so to the extent that all four of them can deliver perfect numbers tonight, there's a lot that the index is riding upon for them to do so. And you could get a situation where the market loves one set of numbers and doesn't like another, and they roughly offset. But you do have, it's really one of the riskier setups that I've seen in quite some time, and without a lot of clarity to it. We'll see after the close, and I guess we'll talk about it tomorrow, and we'll see where the markets are on the back of all that market-moving news. As I've put before, where there's this much uncertainty, you really better be managing your risk properly, because going into this number, there's a lot of index movement riding upon this, not necessarily spilling into other stocks necessarily. In some cases, they're fairly idiosyncratic, but the markets have a lot riding on this. Decide before tonight whether your risk is managed appropriately. Have a good one, everybody.